Right now, the median U.S. home price is $420,000. To put down 20%, you need $84,000 in cash, upfront. For generations, Americans have operated on the premise that renting is equivalent to throwing money away, while buying a house is the only reliable path to building wealth. That logic held up when mortgage rates were sitting at a historical anomaly of 2 or 3%. But today, buyers are locking in rates between 6.5 and 7.2%. At these higher rates, the amortization of a 30-year mortgage shifts. For the first decade, your monthly payments pay down the bank's interest rather than building your own equity. This chart shows the monthly outflow of both options. Notice the segment representing interest and property taxes on the right is equal to the entire monthly rent payment on the left. Both parties are surrendering these funds to a third party. Blindly following outdated housing advice in this environment leads many middle-class earners to trade their liquid wealth for high-interest debt. We can see the divide more clearly by testing a $400,000 home purchase with a 10% down payment against renting a similar property for $2,200 a month. This chart builds the true monthly cost of owning that home, starting with the base principal and interest payment of $2,274. Property taxes average around 1.1% annually, which adds $367 to that monthly total. Homeowner's insurance adds another $150. Because the down payment was less than 20%, the bank charges an additional $200 for private mortgage insurance. Ongoing maintenance adds a final $500 to the stack, based on a standard 1.5% annual upkeep estimate. This brings the homeowner's total monthly outflow to $3,491. Compared to the $2,200 rent payment, the homeowner is facing a $1,291 monthly deficit. In this scenario, the primary residence functions as a significant, ongoing drain on a household's monthly cash flow. This leads to the question of opportunity cost, the wealth generated if that same capital were invested in the broader market instead. This graph tracks a renter who takes their initial $40,000 down payment and places it into a diversified investment portfolio. Every month, the renter also invests the $1,291 savings they captured by choosing not to buy the house. We'll apply a conservative 8% annual return, 2% lower than the historical average of the S&P 500. After 10 years, that initial down payment alone has grown to $86,383. When you add the compounding growth of those monthly contributions, the total liquid wealth reaches $449,230. By contrast, a homeowner after 10 years of payments still owes hundreds of thousands of dollars to the bank. To match the renter's $500,000 portfolio, the home's value would need to appreciate at rates far beyond today's historical norms. Beyond the raw numbers, geographical flexibility has become a critical financial asset in the volatile job market of 2026. A homeowner is often locked in place, potentially waiting months for a buyer if they need to relocate for work. The cost of exiting that position is high, with 5 to 6% of the home's total value going to realtor commissions. Closing costs consume another 2 to 3%, further depleting the owner's realized equity. Renters maintain the ability to break a lease and move across the country to capture higher-paying career opportunities with minimal friction. This mobility is likely why 36% of Americans are now choosing to rent for longer periods than they originally planned. With rental vacancy rates rising to 6.5%, many renters are finding they have the leverage to negotiate lower monthly costs and better terms. In the 2026 economy, renting has evolved into a strategic choice for those prioritizing liquidity, mobility, and predictable wealth building.